Rahul Jain joins us now, Vice President Research with Dolat Securities. Let's understand from him what he makes of the current market setup and how IT companies are likely to react to numbers. Rahul, first the howler from Infosys. It's almost like a no ball or a white ball, whichever term you want to use it. For second quarter now, Infosys has cut their guidance. One side they're talking about big deal wins, and then despite those deal wins, they have cut their FY24 guidance. Is this some kind of an indication of more pressure coming?
Yeah, I think the translation of order book not culminating into the revenue growth is more to do with a delayed start for the deals, and secondly, what we can call as a leaking bucket. So whatever 95% of the revenue that essentially come from your repeat customer, there are project completion which are not followed by the backfilling contracts, or there is sudden stop in the discretionary spend by some of the client versus what they were planning to deliver, commit to these vendor, and that's why you see back-to-back guidance cut. In fact, if you pick one of the comment which we saw was very stark in the TCS commentary, was that they said, forget next year, we see there's no visibility beyond a fortnight. And that is why you see a consistent miss on the guidance or growth because it's a highly hyper uncertain scenario.
So what's that miss, Rahul, going to spell out in terms of a stock move? Because most of these IT names actually recovered quite nicely from their 52-week lows. What happens now?
Yeah, I think from a large cap perspective, the absolute valuations were reasonable given the kind of a markets we are in, and that's why we see there was an opportunity. A lot of long-term investors were seeking into the large cap name, and that's where kind of a up move we saw during this quarter. Of course, the results are not adding any comfort, and that's why they are giving up some of this upside which may continue for next few days as more result and more disappointment come in. We could see a severe cut today as well. Uh, I think the sharper moves have been more evident in the mid cap names where the execution has been better on the relative basis. Of course, they are not very different from what the sector can deliver, and thus eventually we would see more pressure on those names versus the tier one names.
Large cap IT names, Rahul, especially the likes of Infosys, is the sense that it'll only be weaker in the near term and that potentially the long term will look stronger. And what do you think will lead to that growth?
Sorry, I could not gather the question.
Was talking about large cap IT, in particular the likes of Infosys. Do you think that it'll be weak in the near term and that long term it'll be potentially stronger growth? And what will lead to that stronger growth?
Yeah, I think there is definite pain going into Q3 and Q4 also because some of this guidance are implying very muted performance, and generally H2 is weaker because of lower number of working days. From a confidence, from a longer term perspective, is essentially coming from strong TCV win. If you see for the three numbers that has been announced in this quarter, we have seen there is a strong TCV addition that is happening. So as long as the order signing are good, eventually the pain on the existing portfolio of customer or discretionary spends would pause at some point of time. And we could see these companies going back to their more sustainable growth zone, which is around 5 to 8% for the tier one and closer to 10 to 12% for the mid-tier names. So that may happen as long as the order book is healthy, which is the case in Q2.
Rahul, is there a case that we will see differentiated numbers from TCS, Infosys, Wipro and HCL Tech? Because now the difference between these top four, which normally followed a pattern, is now more and more stark.
Yeah, I mean, on a longer chart, we have always seen TCS and HCL Tech doing well on a 5-year, 10-year basis in the last 1 decade, and followed by Infosys and much lower growth coming from TechM and Wipro. So far, the way the year is progressing, it's not very different. This time, of course, Infosys is looking more weaker in this particular year. But if we pick up from a 3-year basis, 5-year basis, I think that leaderboard of the growth trajectory organically is not very different. So HCL, TCS leading the growth in the tier one name, followed by Infi, and then Tech and Wipro after that. So that moreover remain intact so far.
So if you have to buy one stock in this decline, Rahul, out of the top four, TCS is giving you a comfort of growth but high valuations. Infosys is giving you uncertainty but it is attractive valuations. And TechMinder to some extent is a promise on turnaround. Every case is separate. Which way should one lean?
So yes, I think you took one or two names which can be a better choice at this point. For example, Infosys, the absolute valuation are not expensive. They have 85% plus payout that they commit. So basically, if they go back to 6-7% types of growth, which looks like a possibility for next year, coupled with 2-3% INR depreciation and 3% types of dividend plus any other payout yields, still make a decent investment case for a 12-13% kind of a return if you look at from a 12 to 18 month perspective. If your risk profile get aligned to that, then possibly that's a choice for you. As far as Tech Mahindra is concerned, given that the growth is pretty low, the margins are very weak, and the valuation are also very slow. There is a good possibility that with the change in the management over next several quarter, you may see a revival of growth and profitability eventually, and thus a re-rating would be imminent. So if you are looking for that, you should have at least have a 3-year horizon in your mind, because these are not going to be so simple ask, especially in this kind of an environment. So that's what I would like to position at this point.
Thanks so much for joining in, Rahul, and putting that into perspective, giving us a sense as to what the outlook is when it comes to IT.